Hi, my name is Janie Vilsbach, and I'm Center Director for the Central Mountain Small Business Development Center. And joining me today is Avery Bechtel and Amy Drengler, both with High Country Bank. High Country Bank has been kind and gracious enough to sponsor our Finance Sense for the last 6 months. And they created a monthly series of finance tips and tricks. So today we'll talk about how to choose the right loan for your business. The Central Mountain Small Business Development Center supports businesses to grow and prosper. And we do that through no-cost consulting, through local consultants, as well as access to statewide experts. We also help with free or low-cost training, and we assist with access to capital, supporting business plans, a lean canvas, performance, cash flow, and even introductions and letters of support to a variety of lenders. We're actually funded through the Small Business Administration, and then we're also funded and managed through the Office of Economic Development and International Trade. And finally, we're supported through our hosts, which is Chaffee, Lake, and Park counties. We actually cover the 3 counties in the center of the state, but I want to make sure if you're watching from other areas that we have 15 centers located throughout the state that can support you on your business journey. At our center, we offer a series of training workshops. Lean Up, Start, and Scale is based on the Lean Canvas, and we also help with performance and cash flows in that segment. We have a deep dive business training that happens every fall called Leading Edge, which is a 10-week series. Finance Sense is held monthly. Then we have a mastermind series that we hold in person several times a year. Innovative Leadership Marketing Power Hour, which is held every 2 weeks, then Business Ops and People Ops. And then we have 2 annual conferences, the Power of We, which is Women Entrepreneurs Conference, which is held each May, this year on May 19th, as well as the Outdoor Industry Summit, which will be held at Leadville CMC campus on September 19th of this year. So with that, I'll pass it over to Avery and Amy.
Well, again, I am Avery Bechtel. I'm with High Country Bank, and my colleague Amy Drengler is joining us right now. She is also with High Country Bank. Thank you for joining us today, and we are just going to jump right in. So today, again, it is how to choose the right loan for your business. And really, this kind of goes without saying, but you really do need to first determine your need. So oftentimes we do have borrowers that will come into the bank that just really haven't yet defined what their need is, how much can they afford, all of these things. What does their collateral look like? So we really like to just kind of go through this list and be able to speak a little bit to each of these items and tell you kind of, this is a place to start. So first, you'll want to obviously consider the loan amount that's needed. So what is your need? The purpose of the loan. So are you trying to buy commercial real estate, equipment, a commercial auto loan? Do you need working capital for slower months? These are all things to consider. You want to think about what payment amount per month really fits into your budget and how is that going to be paid? What's the source of funds? So, those are all important questions that your lender will likely ask you. So it's important to have answers to those prior to that even being asked. Another thing that banks and financial institutions often require is personal guarantors. So that's something you'll want to consider. What does your personal cash flow look like? So what are your taxes? How are those looking? What's your credit score like? You want to just think about all those things, as those are things that will come up in these conversations. The other thing at High Country Bank, we do require collateral to secure loans. However, every financial institution is different. Every bank has different requirements, and some may offer unsecured loans, but that is something that you're going to want to really consider, and we will talk about that a little bit more in detail here momentarily. So next up, if you've attended some of our classes in the past, these Finance Sense classes, you've probably seen a similar list to this, but we're just going to kind of run through these. And for starters, these are just different types of business loans that we're going to speak to today. That's not to say this is all inclusive list, but these are items that we're going to speak in more detail on today. So first, there are commercial construction loans, business lines of credit, equipment financing, commercial auto loans, commercial real estate loans, and then we have the SBA 7A and 504 loans. So we're going to dive in and talk about a little bit about each one of these. And here you go, Amy.
So commercial construction loans can help you and your business cover the costs associated with building or renovating structures. So before you come to the bank, you might want to think about what collateral you have that will be required to secure the loan. Are you going to buy vacant land to build on? What are you going to build? It's helpful to have the plans and specs, your site plan, your budget. You might be working with a general contractor to help develop those things. So when you come to the bank, you can have a meaningful conversation about what your needs are. Generally, construction loans are short term, so 1 or 2 years, because it's just to get you through that construction phase. Usually they're structured as monthly interest only payments. So it's a little bit less of a payment than a principal and interest payment. When you're submitting draws for the construction loan, you're going to want to make sure you keep track of your invoices. You're going to be writing checks. So you're going to need copies of those checks. And you're going to be putting together a draw sheet to submit to your lender to get approved for that construction draw. So you're going to be monitoring your budget throughout the process of your construction project. Something else to think about is each bank is a little bit different about how they figure out what your loan amount can be on a construction project. You're going to have your project appraised. So you're going to get an as completed appraisal. Some banks might only lend on the budget, and some might lend on that as complete value. So if your budgeted cost to complete is, say, $500,000, and this bank is only lending on that budget, then your max loan amount could only be $375,000 versus a bank that might have an as complete value. So for example, if you have an $800,000 value when your project's complete, then your loan amount could be $600,000. So it's really important to know what your lender offers and if they're going to use the budgeted amount or the as complete appraisal value. The next type of loan we're going to talk about are business lines of credit. Opening a line of credit is a great way to have access to funds for working capital needs throughout slower times. It kind of functions like a credit card, but this line of credit is going to have usually a bigger limit than a credit card, and it's going to have a better interest rate than a credit card. Again, you're probably going to need collateral to secure the loan, so maybe real estate or equipment. They're usually short term, so you're going to have to renew it every couple of years. These also offer monthly interest only payments, and generally the lenders like to see the loan revolve back to zero during the term, which just means the lender wants to see that you're able to pay it down once you get the funds. So if you need to buy some inventory but are waiting for payments from customers, they want to see that those payments from customers are paying the line back down.
Yeah, and Amy, I'll just interject really quick. I do have a lot of customers here, especially in seasonal industries like we have in Salida, whether that's rafting industries or, any of the outdoor industry companies that we deal with that really can utilize this. So during their slower months, which typically are the winter months, they can kind of draw on this. And then in those summer months, they're able to pay that back down to zero and really revolve it, have a true evergreen line, if you will. And that's what we really like to see as lenders, is kind of that utilization that's drawing up and down. And then that really shows that you have the ability to service that debt.
Yes.
So we're going to get into talking a little bit about commercial auto loan and equipment financing. So a couple things about both of these, commercial autos and equipment financing. Really, the collateral, obviously, in these situations is typically what you're purchasing. You can do loans where, say you already own a tractor that's free and clear. you want to buy a new piece of equipment, and for simplicity's sake, you want to pledge that particular tractor. We're going to take that as the collateral. You're going to purchase this new tractor over here. So that's certainly an option, but traditionally speaking, most folks are wanting the loan to purchase this new equipment or new auto loans or new auto. So kind of what needs to take place there first is we need to get a value that we can derive so we know how much we can lend off of that collateral. So it kind of varies in the situation. So both for auto loans and equipment, if you're purchasing it new from a dealership, for instance, we can lend off of their invoice, so their purchase order. So we're able to use the actual MSRP. And so that makes it pretty simple. If you are buying from a private party, that can be a little bit trickier, but certainly doable for sure. And how that kind of works is we would pull our own value based on the specs of the vehicle or the equipment itself. And then we're able to derive a value that we can lend a certain percentage of. So depending on the collateral itself, the year model, we then can lend, say, 70% of that equipment or 60%, kind of depends on the year model and what we're looking at as far as the equipment itself. As far as terms go, for the commercial auto loans, they're typically, at least for us, and again, these terms can vary at different financial institutions. Dealerships could potentially be longer terms, lower rates, just totally depends. But typically through us, at least, these commercial autos are a term of 6 years, depending on that collateral. And then the rate, down payment, and term really vary on the year model of the collateral itself and the borrower credit score. So it's kind of a two-part deal. We have a matrix for these that we look at. It's a little chart that we're able to say, oh, okay, you're 750 plus credit score. This is kind of where you fall based on the fact that it's a 2017. So we really have a chart that we fall into for these types of collateral. So again, for both of these, they're monthly principal and interest payments. And for equipment, so typically max term of 7 years, again, depending on collateral, also depending on the financial institution. So next up, we're going to talk a little bit about commercial real estate loans. So these are kind of your brick and mortar. You'll see a lot of these downtown Salida, for instance. So this is, obviously to purchase commercial real estate. So whether you're purchasing something downtown, something on the highway, a factory, you're trying to manufacture out of a really big steel building, it's all one and the same. So commercial real estate. So kind of how these work as far as the collateral piece of it goes, we secure the loan by taking a lien against the commercial property itself. So these, when you're purchasing something, or if you already own it, we can certainly take a lien against it if you don't have a mortgage on it, or if you're trying to purchase that property, we would take a first deed of trust. Typically, how these commercial loans work is they have a 3 to 5 year balloon, and at that maturity date, usually you have the option to renew that loan. We have a maximum amortization of 25 years. So unlike a residential mortgage, those typically can go out 30 years. We are capped out at that 25-year amortization. So you want to be considering that when your lender is figuring, your monthly principal and interest payments. For us, at least at High Country Bank, those are factored in at a max term of 25 years. Now we can lower that if, we have some borrowers that say, nope, I want to for sure have this paid off in 15 years. We absolutely can honor that as long as you feel that you can service the debt. And if that fits and it works for our debt service coverage ratio, which we'll talk about here in a few minutes, and you're still qualifying with that 15-year term, then we certainly can shorten that term for you. So again, these are monthly principal interest payments. And that is obviously figured based on, whatever rate you end up at the time. Right now, we base our rates off of Wall Street Journal Prime, which is 8% currently. So just kind of depends on the market when you're buying as to what your rates are going to look like. Typically, our index is 1% over, but can vary depending on credit, the property itself, the type of loan, those kinds of things. So typically 75% loan to value on these, and that value is derived, it's either based on the purchase price or the appraised value, and we go with whichever is lower. So this has often come up before say you're purchasing a property for 700,000 and it appraises for 900,000. You're really lucky. You've got some instant equity. That's awesome. Unfortunately, we're still going to lend off of that $700,000 purchase price. It's the more conservative approach, and you are building equity right off the bat. So that's great news. But unfortunately, if it appraises for 650, we're gonna lend off of that 650. So something to consider. That appraisal is pretty important. But we will loan off of the lesser of the two. So just bear that in mind as you're shopping for commercial real estate.
I'm going to talk briefly about some SBA loans. There was a presentation in January called SBA Lending Essentials, which contains more information on SBA financing. But I'm just going to kind of briefly cover 7A loans and 504 loans. The 7A loan program is SBA's most common loan program. The maximum loan amount for a 7A loan is $5 million. Key eligibility factors are based on what the business does to receive its income, its credit history, and where the business operates. The 7A loan is structured a little differently than the 504. The SBA partially guarantees a portion of the loan amount up to 85%, and another lender actually holds the note. A 7A loan can be used for long and short-term working capital, revolving funds based on the value of existing inventory and receivables, the purchase of equipment, machinery, furniture, fixtures, supplies, or materials, the purchase of real estate, which could include land or buildings, the construction of a new building or renovation to an existing building, establishing a new business or assisting in the acquisition, operation, or expansion of an existing business, or refinancing existing business debt under certain conditions. The benefits of a 7A loan is to mitigate risk with up to that 85% SBA guarantee. The 7A can provide loans to small businesses that don't meet conventional credit requirements so that the business can expand its product offerings without hiring staff or incurring capital expenditures. With 7A loans, eligible costs and fees can actually be rolled into the total project cost. And the 7A loan is usually helpful when there is a collateral shortfall. With the 504 program, you can get a long-term fixed rate financing for major fixed assets that promote business growth and job creation. The maximum loan amount for a 504 loan is $5.5 million for a specific project. The structure is different than the 7A. 50% of the loan amount will be financed by a bank, and up to 40% will be financed by the SBA. And then 10, 15, or 20% will be by the business owner. It really depends on the type of business and if it's a startup. It's important to think about with these 504 loans that your cash flow has to be sufficient to cover 90% of that debt. An SBA loan can be used for purchase or constructing new facilities, machinery or equipment, improvements or modernization of existing facilities and infrastructure, and certain refinances. The benefits to the 504 program are that you can probably get a low down payment between 10 and 20% with up to 90% of the project being financed. There's long-term fixed interest rates for 10, 20, or 25 years, depending on the project. And there's no maximum loan amount on the bank's portion of the loan, so it's flexible. It's just that the 504 SBA portion is capped at that $5.5 million. And professional fees and interim financing costs can be rolled into the total project financing. It's important to remember with these SBA loans that they're technical, so it's important to start working with the lender right away if you're interested in these types of loans. There's a lot of documentation required, and getting started on that early is best. And then we're going to talk about the debt service coverage ratio quickly. It's what commercial lenders look at when determining if the borrower can repay the debt. So the debt service coverage ratio measures cash flow available to pay debt obligations. Ratio minimums vary across financial institutions, but typically commercial lenders want to see at least 1.2 to 1.25. So a DSCR of less than 1 is going to indicate that investors or owners are going to be likely to have to pay and contribute their own cash to cover debts and expenses of the business. If the DSCR is exactly 1, it's going to basically say that the debts and the cash flow of the business are basically equal, and that there's not a lot of extra cash for, unforeseen expenses and costs. So that's why the lenders want to see above a 1, which shows that there's going to be extra cash available. So that 1.2 to 1.25 is where lenders are starting to feel comfortable that the business has enough cash to operate and pay debts and cover, those unforeseen expenses. So basically, if it's a lower DSCR, it's considered a higher risk business, and a higher DSCR is considered a lower risk business.
Thanks, Amy. So we are going to kind of circle back around to this. We have talked about this in the past. If you are a part of our top items to consider for small business loans, on February 13th, we did talk about this, but we feel it's imperative in this finance sense as well, just to kind of reiterate what it looks like prior to you coming into the bank. What are we going to ask for? So these are just a few. This is not to say that this covers the whole list, but the financial and legal documents that you may need are as follows. So as commercial lenders, we are going to ask for at least 3 years of personal and business tax returns. So you'll find oftentimes on the residential side, they may only need 2 years of tax returns. We do need to see that 3-year history to really be able to analyze historic cash flows. So we're going to ask for business financial statements. So for instance, at certain times in the year, we understand your taxes may be on extension, those kinds of things, depending on where we're at. So we like to see a profit and loss, a balance sheet, kind of get a gauge of how things are going for that year that we're in. Personal and business bank statements, ID, obviously, anytime you come into the bank, we're going to need that if you're opening up an account or originating a loan. Commercial leases, if applicable, business licenses. You do need to be registered with the Colorado Secretary of State if we're originating a business loan. We really like to see a bio. So a lot of times what I tell our customers is I'll be taking your loan often to loan committee. I want to be able to tell your story. I want to be able to speak to why you are asking for whatever you're asking for, whether that's a line of credit for $100,000 for working capital, you're trying to buy a commercial real estate business downtown, whatever that may be. I want to really be able to tell what your history is, what's your professional bio. So tell me how long you've been in Salida or Buena Vista or wherever you came from. Tell me kind of your history, your professional work life, why you're doing what you're doing now, and how you have the expertise to do so. So really like to be able to tell your story and stand behind your loan. So a business plan, budget, pro formas, these are all things that SBDC can help you in creating. If you don't have those things, they have a wealth of knowledge and many, many resources to help you do so. Down payment, collateral, these are other things that you're going to need to consider. So say you're purchasing commercial real estate like we spoke about, so that 75% loan to value, that equates to needing a 25% down payment. So you really want to consider, what does this look like? How am I going to have these funds to do that? Do you have friends and family that could, lend you the money? Is it a gift where you're not going to have a payment to friends and family? Is the seller potentially willing to do a seller carry for a portion of it? So there's some different ways to be creative. You have other collateral, that we could take to kind of get a little closer, close that gap. So there's ways to be creative, and we really love sitting down with folks to be able to kind of work through your situation. Everyone is unique, and we know that no business deal is alike, and no business is alike. So we really like to sit down and get your history, see what you're trying to do and try to make those things happen. That's one of the things I love most about commercial lending is getting to see these deals come to fruition in the town and the community that I love, and getting to support those businesses going forward. So this is not just about being a banker for me. This is about being a community member and someone who's invested in my friends, and I want to see them do well. So please, anytime, don't hesitate to come and talk to us as lenders if you just need some advice on what it might look like to have a loan. So we're happy to always chat with you about these requirements and any other requirements that could be asked of you. So Amy and I put together a few frequently asked questions. So we deal with the same questions over and over, and we just felt like it might be helpful to go ahead and get these out of the way. And it might not be something that you've necessarily thought about yet, but we want to at least touch on these, and then we will stop recording. And if there are any questions, then certainly we will take those. But these are just a few questions that do come up fairly frequently as lenders, and we just thought we'd go ahead and touch on them. So the first being, how long does it take to close a loan? So the commercial lending process is definitely different from the residential mortgage process. So I really can't speak to their process right now, how long their timeline is, but different dollar amounts can trigger different processes in the bank, and smaller loans can typically be approved and moved through and closed more expeditiously than larger loan amounts. So larger loan amounts oftentimes need additional review, whether that's taking it to loan committee or further credit department analysis, or if it's at a certain threshold, then it may need to go to our board. So just kind of depends on the size of the loan itself as to what the requirements will be and the timing. If it is a smaller, say, auto loan, and it's pretty cut and dried, we have everything we need, obviously we can push those through a lot quicker than some of these larger deals. So kind of case by case situation. Each bank has their own structure and policies though for those, and different timelines. So it kind of just depends on, you have to ask those questions to your lender specifically. So next up, this is probably the biggest question we get, and that is, what will my interest rate be? So it is a bit of a volatile environment right now, to say the least, as far as interest rates go. So it's been, some tough conversations, because rates are higher right now, quite frankly. I don't think that'll be the case forever, but for now, that is kind of where we're sitting. So it can kind of just depend on a few different scenarios. So it's obviously going to depend on what type of loan that you're originating. So oftentimes construction loans, lines of credit, those are going to typically tick your interest rate up a little bit. And then, obviously the term of your loan, what your credit score is, your net worth, all of those things kind of factor in and do affect things like rate. So it kind of just depends on the situation itself, what you're purchasing, and all of those things kind of combine together to create your term. But we do have, basic guidelines that we try to follow and keep those, depending on the type of loan, we try to keep those within a certain range, if you will. And then it's going to just really depend on the risk, the credit rating of each, and the collateral and such.
Sure. So what makes a commercial loan different than a mortgage loan or a consumer auto loan? So we kind of touched on that earlier with just like what we're needing to collect. So usually, it's that more years of tax returns, usually 3 years. We really take a global analysis. So we might, if you have a couple other businesses, you might want to see those business returns. We can look at a little bit more sources of income than probably mortgage lenders. And so we're going to really take a really big analysis of, your total cash flow. Usually we have different LTV guidelines. So, we're around that 75%, and mortgage loans can go up quite a bit higher. And mortgage looks at a DTI calculation versus the commercial looking at that DSCR calculation that we talked about. And then the amortization term and maturity terms, usually those are a lot shorter than mortgage loans. Certainly there's different mortgage products that have different maturity terms and amortization terms, but ours are going to be shorter usually. than like a 30-year fixed mortgage loan. Fees are just going to vary. I know they vary with mortgage loans, and they're going to vary with each type of commercial loan. So you're really just going to want to ask what's going to apply to your specific loan. And interest rates, we already talked about, those just vary on the situation. But there might be options, if you get an adjustable rate versus a fixed rate. So it's important just to ask and know what those options are. A lot of people want to know if they're going to have to personally guarantee the loan. And I mean, most of the time, yes. It's pretty rare for us not to have a personal guarantor on the loan. I mean, most of our loans that we're seeing, are smaller businesses or newer businesses. So we're really going to need that personal guarantee. And I think that's pretty common in the industry. I know with SBA loans, they're going to require that as well. And I guess we should make sure what a personal guarantee is, and it means that guarantor is personally liable for paying back the loan, even if the business is no longer in existence.
Yeah, thanks, Amy. And then last that we put together here, are there prepayment penalties? So make sure you ask. It all depends on the financial institution. So it could vary based on loan amount. Not all banks have prepayment penalties, but some do. So it's really important to be informed on this. You certainly don't want to get 5 years in and say, wow, I'm ready. I've been saving for years and I'm ready to pay off my mortgage, and then have to pay $10,000 in prepayment penalties. So it's definitely a good question to ask, and make sure that you're informed on that, because it can certainly be a surprise if you don't know that one is there. So the SBA typically has prepayment penalties. Not on all of them, but I certainly run into that with certain borrowers, and we've refinanced particular loans and had to pay those prepayment penalties off. So something to definitely be aware of. Theirs is typically on a sliding scale. After 5 years, I believe it adjusts depending on how far along you are in the loan. But I can't speak to that for certain, but I think that's how it typically works depending on their type of loan. So definitely something to ask your lender. So at this point, we will open it up for questions. I believe we'll stop recording now, and we just want to thank you for your time. It's been a pleasure being with you.